Excuse my lower than normal disposition. Some bug is spreading over Europe, and that's the one thing I have stumbled upon. So my throat won't be such vocal as Vladimir Putin declaring war on Ukraine, but also assume my message won't be such blatant as that item. I'm feeling better alongside with the market that was on the verge of a major slash of valuations when the US 100 will cross that magic barrier of 10.6, that is keeping us from building another like downwards. So S&P 500 was 1.75%, DJI was around 1.05%, and US 100 around 2.8 when yesterday. Today we'll talk about what's to come in 2023. We'll ramble about the prognosis of what defragmentation of the world may bring to us, and what is the price for the what's the price for the US dollar? What's the prognosis for this in terms of the future results? And I'm very glad to host you. That's fantastic. You decided to keep your ear to the ground and to find out what's out there. So, without any further ado, let's get into intro. All right. So, what's about wages? So we are wondering what 2023 may bring to us, and one of the elements that may break is wages. Recently, we were going through growing unease, causing labor costs, crimping the flow of money out of heavens and into assets that thrive in an economic upswing. So investors back in November and December were positioning for rally in risky assets next year. But one of the things that they may be underestimating is exactly the communicate I've just have put up. So we are going through a definitive battle of 2023 that still have a chance to save ourselves from a recession. So it's labor versus the paymasters that the war has already begun. So if wage hikes go through, it will be kind of stagflationary and a headwind for markets, both bonds and stocks. So we cannot raise wages forever. The question is, how long can it go? For companies that for companies, it's more and more difficult to borrow money. That's why they have limited room for expansion. What would it take the extra money to cover workers' needs? The question is posed. So we cannot put those companies into debt even more, as the cost of those debts are rising with higher interest rates. So something looks like gets about to break right here. I don't know whether it would be the supply side or demand side that will break, but Fed is ready to break the labor market at all costs in order to fight with inflation. So I would bet right now for stocks with long tails of earnings distribution. I would bet that those companies might have tough time. Otherwise, I would say about those companies that earnings distribution is not such long tail. In this interest rate scenario where we cannot keep up with the policy that right now Fed has posed on the economy, I would bet for a solid and with sound foundation companies that more often than not are the value stocks rather than the growth stocks. So at least next quarters might be favoring those solid founded companies. So if you haven't noticed, we have a chat going live. Let me find out that everything works fine. So I would may continue this transmission alone. So yes, everything works fine. If you have any question, just put it in the comment section live or below the video in order to get to them later. So if you have a shortened question, just put it in the live chat. On the other hand, you may put it below the video if you have some of a more complex one. All right, so that was about the wages. Right now we are jumping to housing market that is used to be a lagging indicator for the whole economy, and right now just look at this Federal Reserve's aggressive tightening campaign to cool inflation had an outsized impact on the housing market in 2022. That's why we've dropped to levels haven't been seen since COVID trench, but we are even lower than it was during 2010, where was this recessive period for the housing market. So we can find here that borrowing costs roughly double where they were at the start of the year. Home sales, therefore, prices have been declining for months. So US pending home sales fell for a 6-month in in November to the second lowest on record as high borrowing costs, and uncertain economic outlook kept many potential buyers out of the market. So with such borrowing costs, it's very difficult to have this market thriving and being robust. That's why we do find that it may spread even over to other elements, other components of the economy, such as labor market in the long run. So those US pending home sales that have previously had a very turbulent time right now are nowhere near from recovering, as I do find that this element won't be managed, won't be sorted out by the government as it was back in 2021. We have literally have packed the market with money, as we haven't had inflation back then. So some of the economists say that home buying activity should inevitably rebound in the coming months and help economic growth, but we still need an evidence in data for this. So 2022 was difficult also because of its unfulfilled forecasts. The market has a tendency to fool the most market participants as it's possible. Recently, biggest forecasters, biggest bulls on the market in 2021, Marko Kolonovich and John Stoltzfos, if I call the surname correctly, two of the loudest stock bulls on Wall Street were convinced of one thing at the outset of 2022. Mr. Kolonovich said S&P 500 will get us to 5,000 points, whereas Stolzfus has claimed 5,300 is still on the side, but they they had to surprise themselves as they haven't assumed that the rate increase, that response of Fed will have such a torrid pace. So they have failed to foresee that would how that would trigger the worst simultaneous rout in stocks and bonds since at least 17th. So these are two men that are the public faces of Wall Street and that becoming somewhat blindsiding the sector, where we are putting once again ourselves into question whether we should trust or rather blindsidedly keep track of the forecasters or market economists and such prognosis. So I do find that more often than not, those prognoses don't work as they are strictly dictated by the media. I would say media push when the bank want to have a good or bad press. They trying to put up such publications that are put in favor the forecast. That's why those forecasts based on their analysis that have that very often somewhat not really complex in terms of elements that they are analyzing is the one thing that why those forecasts based on them are not fulfilling themselves. That's why we need to rather react to the market than prognose. We should have a particular strategy that will adjust to no matter where the market is. So we may also adjust our engagement into the markets when the market's crashing and lower this lower the weight of it when it's rising. But it needs to be really particularly written down and applied accordingly. So forecasting is the one thing of a foolish game that we shouldn't trust in more than 50%. All right, so deglobalization as a theme trend of 2023. So the normal thing is that at the end of a year, we are looking for themes that may permeate next year on the markets. One of the most remarkable of them is slowing down globalization processes that were unifying the world throughout at least recent 30 years. Both in US alongside Europe have right now two strategic concerns in a turbulent world, diversifying supply chains and allocating capital away from risky markets and toward what they will see at the relative political and economic safe haven of the US. So defragmentation becoming a major inflationary component that may be nagging for Fed. Inflation is not that easy to get rid of as it seems. The global move pushes West countries to reassess their reliance on China, no matter they make cars or smartphones or other type of high-need products, are really need to answer many questions. Where do they need to go forward? Alongside this deglobalization process, something that will be a financial priority is the leveraging. Investors have been rewarding companies to keeping debt under control, and that's unlikely to change anytime soon. It's hard to think about the growth and economic expansion right now that may lead to ramping up valuations of risky assets, however. That's why one of the main slogans during first half of next year will be patience is a virtue. That's why uh, I wouldn't bet everything on stocks right now and during next few months. Sorry for my throat. It's not as in a good shape I have um expected, but we are going further into market outlook, and I need you to jump to DXY. That's in a one of the important spots right now. So DXY eventually broken downwards out of this pennant pattern that we have recently discussed. So it means we are getting back toward this 103, 102, 96, where the major support may find its place. So I wouldn't bet against DXY right now. I would rather listen to the market and how they would react to the levels I've appointed. But you need to be very cautious in this side or another. Possibly when a DXY will revert its trajectory, indexes would have a tough time. For this one to happen, US 100 are more likely to go downside than the upside, but it's yet to get showcased. That's why if you haven't subscribed to the channel, you may do it right now in order to get updated. Right? So we are heading back to market outlook, and market movers is the one thing. Oh, sorry, I have switched it to fast. So in terms of economic calendar on Friday, I've told, yeah, there are many countries I've put up, but out of the most important data on sorry, it's 6th of January. Where did I go? On Friday, 30th of December, that's manufacturing PMI out of China that is worth looking at. So if you are interested in Chinese markets, you may watch it with a close attention. So that was the economic calendar, and we are heading back into trade idea. So in terms of trade idea, I have for you a market of let me find out what was it, WTI to USD. So we are right now in a rebound structure where we have rebound out of the, don't look at the green lines, but because it's my targets of the price, but these are not supports nor resistances, and these are just my marks. So on the black are important lines that are symbolizing supports, resistance, or trend lines. Right here we have a long-term trend line that have been set on 25th of August, and we are respecting this trend line. We are respecting this trend line, and right now it looks like we are rebounding downwards. We have formed on a 1-hour chart a double top formation with a quite significant volume, symbolizes typically element of a pivot. Recently, we've also formed a lower lows, especially visible on 1-hour chart, and we have tested this lower highs twice. That's why we can find that the bears are working around this area. We are still haven't confirmed or otherwise speaking, we haven't validated at this level yet, as we have broken through this recent um, lows. So another stop is at around 37.8. So we have still around 5% of a drop ahead. So in terms of short position, it would mean for me something like this one. You may wait for even getting the price somewhere around this level, but I would bet we won't cross through 79 bucks anytime soon during this tendency. So right now WTI USD is the one chart that is more likely going downside. I do expect that this risk reward ratio at 6 point. Sorry, I need to lower this down as I would protect this position even with a bit wider stop loss. So if we cross above 78.9, I wouldn't bet this. I wouldn't bet this proposition of the trade as being valid. But otherwise, I do expect that this movement will play out. So if we just wanted to write or draw down the possible path for the WTI, it will be like, yeah, with respect, maybe those weeks, it will be like, I would say like this with Wednesday's date to play out for those profit to get taken. So in always remember about putting stop losses, about putting alarms, if alerts, if you wanna find out what's going on with your position. So in my view, it's this risk reward ratio at 3.9 is still a very decent or even higher because the price has moved. So always become kind of a humble. So never overestimate where the market may go. That's why play cautious. Thank you very much in today's episode. Happy New Year. That's the wish from my side. I wish this year or the next year will become much more profitable, at least that good as it was back in 2022. That's why I'm very glad you are with us. That's why the next year might be very, very, uh, very happy to all of us. So thank you and bye bye.